We are covering installment sales, which are reported on Form 6252, allowing a seller to recognize a gain over time as payments are received, rather than all at once in the year of the sale. This is a tested concept because of its specific rules and exceptions. The core of any installment sale question is calculating the gross profit percentage. This percentage is the gross profit from the sale divided by the contract price. You then apply this percentage to the principal portion of each payment received during the year to determine the taxable gain to recognize. For example, if you sell land with a basis of $120,000 for a contract price of $200,000, your gross profit is $80,000. The gross profit percentage is $80,000 divided by $200,000, which is 40%. If you receive a $20,000 principal payment in the first year, you must recognize a gain of $8,000, which is 40% of that payment. The exam will absolutely try to trick you with depreciation recapture. Any depreciation recapture under Section 1245 or Section 1250 is ineligible for installment sale treatment. It must be recognized as ordinary income in the year of the sale, regardless of whether any cash was received. Let's adjust the prior example. Imagine the asset was a building, and of the $80,000 gain, $30,000 is Section 1250 depreciation recapture. You must recognize that $30,000 as ordinary income immediately in the year of the sale. For the installment calculation, you reduce the $80,000 gain by the $30,000 recapture. Leaving a $50,000 Section 1231 gain, you also increase your adjusted basis by the recognized recapture amount. This is a critical step. The basis for the installment sale becomes $150,000, not $120,000. The new gross profit percentage for the remaining gain is now 25%. Another major exam trap involves who is eligible. Dealers of property cannot use the installment method for sales of their inventory. If a question describes a real estate developer selling lots from their development, that's a dealer selling inventory, and the entire gain must be recognized in the year of the sale. The third trap is related party transactions. The exam loves these scenarios. First, if you sell depreciable property to a related party, such as a spouse or a controlled corporation, you cannot use the installment method. The entire gain is recognized in the year of sale. Second, for other property, there's a 2-year rule. If you sell property to a related party on an installment basis, and that related party sells the property again within 2 years, you, the initial seller, must immediately recognize the rest of the deferred gain. Finally, remember that interest must be charged on the deferred payments. If the agreement doesn't state adequate interest, the IRS will impute it, converting part of the principal into ordinary interest income. To keep the main exclusion straight, remember this phrase: dealers, depreciation, and dependents don't defer. This covers dealers selling inventory, depreciation recapture, and sales of depreciable property to related parties, which we can remember with the word dependents.